Hello everybody, welcome back to another valuation investing video, and today we're going to go over United Healthcare once again because the stock does not stop going down. And taking a look here today, it is down almost 7%, under $250. I had a lot of people telling me that this stock will not go under 250, and I said I was going to potentially be buying under 250, and as we can see here, it has gone under $250. It's at 248. Over the past year, it's down 56 plus percent. This stock just doesn't seem to stop going down as a result of terrible earnings and just the industry just crashing late. So in this video, I'm going to be going over United Health's previous earnings and then going into why I believe this stock is continuing to crash, then going into the financial health of United Healthcare stock, and then finally using my intrinsic value calculator to tell you guys where I think I would be buying this company and if I would even be buying. So the first thing I'm going to be looking at is United Health's recent earnings report, where they recently updated us what they believe is going to happen in the future. For the full year 2025 revenue outlook, we can see they expect $445.5 billion to $448 billion, which is actually a pretty good increase year over year. But the biggest problem here is the full year 2025 earnings outlook, which is going to be $14.65 per share, adjusted of at least $16 per share. So they're saying it's going to be over $16 per share. So that's not very good compared to the revenue growth rate, but at least it's still not terrible. Compared to other companies in this health insurance industry, some other companies are completely slashing their guidance to where they're going to be going negative growth over the next year. And even some companies such as Centene are losing money. So United Health, as one of the biggest health insurance companies, is showing us they are a bit more resilient. And seeing here, the second quarter earnings were $3.74 per share. Adjusted were $4.08 per share, which was a big decrease from last quarter. And taking a look here, we have the net margin, which is the biggest deal, I think, with United Health and what we need to be focused on. As we can see here, March 31st, 2025, before last quarter's earnings, which they just reported just not even a week ago, they had a 5.7% net profit margin. Now this quarter, they had only 3.1% net profit margin as a result of increased medical costs. As we can see, the second quarter consolidated medical care ratio of 89.4% increased 430 basis points year over year, meaning they're having to pay more and more for their customers because of more medical costs in the business. But for the full year 2025 medical cost ratio, they expect to be at 89.25% plus or minus 25 basis points. So probably right around 89%. So that's still very high. And before this, their all-time high medical care ratio was at 85.5%. So this has really increased by a huge margin because of the increased spending they have to do for their customers. And now they're going to have to reprice their plans and probably increase prices in order to increase that profit margin back up to normal. So that's going to be a problem for United Health. Maybe we'll see less revenue growth, but more net income growth because they're going to have less sales because of less customers staying with the company in the future. So that's going to be a bigger problem with all these health insurance companies. They're going to have to be raising their premiums by a lot more. So that's the big issue with all these health insurance companies. And taking a look at the year over year growth rate from the revenue, we can see that the revenue actually from 2023 to 2024 grew by about, I'd say 8 or so percent. So 8% year over year revenue growth is actually pretty good. And they expect this year to be in like the 445. They're supposed to be at $445 billion of revenue. So this is still expecting a very big increase, greater than 10%. They're expecting greater than 10% revenue year over year growth still. So at least the revenue growth for United Health is still very strong. But the biggest problem here is the EPS, in which 2023 to 2024, we saw a big decrease in their earnings per share by about 20 to 25%. And right now they're at about 24 earnings per share, but they're expecting this for the full year to be at about 16, a little bit over 16 earnings per share. So they're still expecting growth from 2024, but not much at all, maybe a few percentage points. But nonetheless, at least the company is still growing both their earnings per share and revenue year over year. So I'm not too worried about this. We just have to see in the future how they increase these margins and plan to repurpose their premiums at a better rate. And going over what the biggest problems UnitedHealth is facing, like we said, higher than expected in medical costs. The company has faced a surge in their medical costs, particularly with their Medicare Advantage plans. These costs have been growing at a faster rate than the company anticipated, resulting in a set of prices for the year, which is squeezing into its profitability, and also weak financial outlook and missed earnings. Like we said earlier, they reduced their earnings per share outlook, but the revenue outlook still looks pretty good. Leadership changes also has been a big problem with this company. They've had multiple CEOs in the past year, like the one that got assassinated, and the other ones have just been resigning out of nowhere, and hopefully these CEOs stay here. Another huge problem that people are worried about is UnitedHealth's legality issues, which UnitedHealth is currently under investigation by the U.S. Department of Justice related to its Medicare billing practices, in which it is supposed that this company has been over-exaggerating how much their patients are sick, and in return, they're actually getting more money from the government because of the over-exaggeration of the medical problems with their patients. So that could be a big problem with UnitedHealth, but nothing has been proven yet. And also broader industry trends, which, like I said earlier, all these companies in the health insurance industry are facing these problems. So while it's not too much worry because it's similar to the industry, it's still pretty worrying because the company has been decreasing by a good amount. And taking a look at the earnings per share, we can see the earnings per share has still been increasing at a pretty decent rate. We can see it's been going up over time at about double-digit rates. So this is pretty good, but the earnings per share that they reported was all the way down here, big decrease in that earnings per share. And taking a look at the revenue, their revenue was actually pretty high all the way up here. So they're still increasing this revenue at greater than 10%, about 10%, I'd say. They've been increasing their revenue year over year at 10%. So this company is still growing at a decent rate, but the earnings per share is the big problem, in which the profit margins are really hurting this company because of the huge decrease in these margins. But I'd like to add there's actually a really good news with this company in this recent earnings report. Even though you might not think there was much good news with this recent earnings report, actually look at the shares buybacks this company is doing recently. We see they're really buying back in 2024, but they've almost reached a record in the past 5 years of how much they bought back this quarter at about 2%. So they bought back over 2% year over year in this quarter, which they have increased these buybacks, which I really like to see with this company, because when a company falls a lot, you want to see in the recent quarters that they are buying back shares when the stock is down a lot. If you see that they're not buying back shares, then they probably think to themselves that it's not likely to do well. If the company is buying back shares when the stock is falling, there's a much better chance, and it makes me more confident in the company that they at least know that they can still come back to what they were before and even improve as a company, and not just be like and not just go away, in which this is really giving me more confidence in this company because of these buybacks. But I'm still worried about all the other issues with this company. In taking a look at my 7-step stock analysis, these are the 7 key metrics that I like to look at for this company. And with the PE ratio, I want this greater than 0, meaning UnitedHealth is a profitable company. As you can see here, 10 PE ratio. This means you're paying $10 from $1 of earnings per share over the past 12 months. So this is a very cheap valuation when compared to the market at a 25 PE ratio. This is 2.5 times less. This is at a 2.5 times less valuation than the stock market, so this is trading at a very low valuation. And I want to see the forward P ratio under 30, in which it's at 11, meaning you're paying $11 for $1 of earnings per share in the next year. So this is a very low valuation, but I would like to also add, this is my big concern, that the forward P ratio, we always want to see this less than the normal P ratio, because we want to see the forward P ratio, meaning the earnings per share will be greater. So if you divide the price of the stock divided by the earnings per share, you want the earnings per share to be greater, meaning the P ratio will be less. So we would want to see the forward P ratio to be less than this, but at least it's not too big of a discrepancy. And the revenue growth and the EPS growth is still growing pretty good over the past 5 years, but it is likely to see that this earnings per share growth rate to decline by a good amount in the next year. The shares outstanding decreasing at about 1%, pretty good. Debt to equity ratio is a little bit high, meaning they do have a little bit more debt than I would like, but it's still not terrible. At least it's not over 100%. And the expected EPS growth by analysts, they expect them to grow about 9%. So Analysts still expect this company to be growing at near double-digit rates in the next 5 years. So I think this company is still looking pretty decent for the future. I think they're in a lot of pain in the next year or so. But after this year, I think they're going to be starting to get back to normal. And this company could be a good buy today. So that being said, using my intrinsic value calculator, I'm going to try and determine what price I would be willing to pay for this company, which I have to use future annual revenue growth rates for this company, which this is going to be for the next 5 years. Normally I do the next 10 years, but I think UnitedHealth is going to be a little bit better for the next 5 years. And for the future annual revenue growth rate, I think UnitedHealth, as they've been growing at about 10% each year, analysts expect them to grow about 9% earnings per share. So that takes into account buybacks and also profit margin. And the revenue, I think they're going to grow about 7% each year for the next 5 years. Now for the future profit margin, like I said, they're at over 5% just last quarter, and it's fallen almost 50% in one quarter to 3%. So, in the next 5 years, do I think that this is going to stay at 3%? I don't think so. I think it's going to get back up to 5% because I think the company will start to gain. I think the company will start to gain ground and continue to get back to normal like they were just a few years ago. Now for the future P ratio. UnitedHealth is trading at a very low P ratio compared to its average, in which it's averaged at about a 15 to 20 P ratio, but since there's a lot of headwinds ahead for UnitedHealth and also their earnings per share decreasing by a huge amount, the P ratio has really fallen by a lot, showing that the company is trading at a lot less valuation. And with that being said, I think a fair future P ratio could still be 15. Do I think that 15 might be too high? Potentially, but I think 15 is still pretty fair, especially when UnitedHealth was trading at about, say, a 20-25 P ratio just 2 years ago. If this company gets back to that 5% net profit margin and starts to grow a little bit less than they were a few years ago, I think a 15 P ratio is still fair. Now for the shares outstanding. I really want to see this company be buying back a lot over the next few quarters, but do I think that's going to happen? Potentially not. I'm going to be a little bit conservative and say they buy back at 1% each year. Even though they bought back almost 2% year over year from this quarter, I think 1% is to be fair. And with that being said, I get a future share price in the next 5 years at about $500, in which the current price is at $249 per share. So I think you can make almost 15% on your investment if you bought UnitedHealth today. But this does assume that their future profit margin gets back in line with what they've been over the past few years. Say they remain at this 3% profit margin, then I think this company, you should stay away. So it really depends on if you think this company can turn around and get back up to this 5% net profit margin, and say they just get to 4%. This automatically brings your return down and up by 5%. So each 100 basis points of profit margin, I think this can change your returns by 5% each. So if they get a 3% net profit margin in the future, I think you can only make almost 5%. If they get 4%, I think you can make about 10% on your return. But if they get up to that 5% net profit margin, once again, I think you can make almost 15% on this investment if you bought it today. And I think this could be a good investment. Me personally, I'm going to be sitting out just a little bit to see what they have to say till their next quarter or if they release anything new. So thank you guys for watching this video on UnitedHealth stock. Please subscribe, hit the like button, comment down below what stocks you want me to analyze next, and also give me some feedback on this video. And thank you guys for watching.